Hello, Tyler Chanelli here of Option Trading Coach at Options Trader Club, and today is Wednesday, June 8th, 2016. The Dow's up about 42 points, the Nasdaq's down 4, the S&P 500 is up 4.5 points, and then the Russell 2000 has been doing very well out of the four indexes, up 3 points. So the market has been choppy. It's been having a very range-bound mentality. It's hard to find a real definitive trend in this first 5-6 months of 2016. So I want to talk to you about a couple things. We put on a recent trade yesterday on Marathon Oil, ticker MRO. It's trading at 1450 roughly when we got in yesterday on our live trade room, and it's continuing higher today. So we'll talk briefly about that. I'm also going to give you a snippet from that live trade room here shortly. And I kind of want to give you just an overview of what I think can happen going into these summer months and really into a very critical time in our U.S. economy, which is the 2016 election. So the S&P 500 ticker symbol is SPY for that ETF to kind of see that that underlying trend here. And look at these candlesticks that are forming now. So these are really critical to see for two reasons. You know, we've been in a sideways trend since really the beginning and middle of April, so to speak. And we had a little bit of a bump higher here the last couple weeks of May and into June now, but we're starting to lose steam. We have these very small-bodied candlesticks with these top wicks, which means that the bulls are not having the volume's falling off, it's tapering off, and it's not really following through to break out of the recent highs that we see over here around 2130 roughly. So the other thing we can look at, which is the same thing as the SPY, is the S&P 500 E-mini futures. And the S&P 500 E-mini futures is /ES, and this gives you a really good perspective of what the S&P traded at. So the high is 2134. We're 20 points away from the high. It looks like we might have almost touched it today, but we're still about 20 points away. So what I'm thinking is, it's a good place, a good time to take profits. It's a good time to sell calls against your long-term leap positions, kind of like what we've been doing a lot with our existing positions. And going into these summer months, it's smart to continue this defensive strategy of selling premium, of not having too much positive delta risk, and using strategies like calendar spreads, diagonal spreads, short iron condors, and then taking some long positions more over than others, with certain reasons behind that for mainly technical. So to show you some of the positions that we have on. This was the one that was put on yesterday, was Marathon Oil. Bought the October 13-17 $4 wide vertical call spread, and it was up about 200 earlier. Now it's kind of fallen off a little bit, but we're still up out of the gate. Some of my leaps positions. A new one that was put on just the end of May, which I like, is Potash. I bought the January 2018 18 strike calls for $225 a piece. They're up to about $285 a piece. And yesterday was when I sold the short-term June options. I sold the 19, so I legged into a diagonal spread to produce this positive theta right here, which is a very important element that I talk in depth about inside the Options Trader Club, through the trading rooms, inside the Trade Mastery Program, the Easy Option Trading course, things that will teach you how to manage these positions and follow along with what we're doing here. So we have some Apple positions that are doing well. You can see that the sold calls are helping produce a little bit of profit as well and create this positive theta scenario that's very important. We also have a few different trades down here that are a little more complex and things that have been on for a while, like these win calls have been on since the beginning of the year, and they're up 500% almost, if not a little more there. So the price to get in was $365 a contract. Now they're $22 a contract. So that's a $365 contract, now worth $2,205. So that's been the best trade for me this year, and that's definitely carried some of the losers and some to kind of give us a nice profitable situation with these leaps positions. Recent trade was on Wells Fargo. That's doing pretty well. We got into these January 1750 calls, and there's a lot of different things. But one thing that I want to talk about to close out this quick update is on a recent trade that was on Tesla. And Tesla was a trade that I got into right here on the 26th of May. and to show you what the chart looks like on Tesla now, because this is a stock that has gotten a lot of publicity. It's doing very well. Huge volume spike yesterday on a breakout, and it looks like we could continue up to maybe 250 or 260. And it's a really important thing that I want to teach you in this video. And right here where my cursor is May 26th. That bullish up day right here. If I zoom in, this bullish up day was when I got into the position, and it's kind of was going against me from getting in around 224, 225 a share, trade down like 215, 218 a share. So I was being defensive, and I kind of changed my position into a calendar spread, which used to be a diagonal spread. And to make a long story short, and not to get too technical with the trade, is yesterday, and this is really the benefit of knowing how to manage positions, how to read the option Greeks, and how to understand the strategies that I use and other professional traders use to increase odds for success, have the opportunity to profit in any market trend, and be very assertive with your decision making to change a trade as quick as you need to when you see things happen, like yesterday on Tesla, which is going to lead me off now. So I want to actually cut here and migrate into the live trading room that talks about how I kind of adjusted and legged out of this used to be a 230 call calendar spread, which now I have adjusted into this long 230, 240 July vertical call spread, which if I hadn't done that, I would not be making $600 today on this one position. So because of that adjustment, I was able to modify my delta risk and completely fluctuate and modify my ideal forecast of where I think this can continue going, and being able to be adaptive and assertive to continue letting this trade work and make profits, which is what we're all about here. So I'm going to leave here and migrate into the live trading room from yesterday that talks about in depth how this trade was modified and really adjusted into this long vertical call spread to where now it's continuing to produce profits up another 600 today with more to go, because I'm still long 70 delta. And now because of this move and because of the modification from yesterday, it's making a little bit of money from theta. And it looks like on the chart now with the volume after yesterday's spike that it broke past the forecast that I had at 238 roughly, where the 23.6% Fibonacci retracement level was. And it could definitely be heading back to resistance around 250 or 260. So I'll leave it there. Appreciate your time, and I will see you in the live trading room. Thanks so much. Hello, welcome to the live trading room webcast for Tuesday, June 7th, 2016, presented by myself, Tyler Shanelli, CEO and founder of Options Trader Club. Busy week to start the week. Before we jump in, we're not going to do too much on here, just real quick disclaimer. And mainly today, we're just going to cover and review all the open club trades. And 1825, this is one where I think you should definitely plan to sell calls. And this is actually a position that I like to be in. You can see how the stochastics is getting a little top heavy, and we're getting a really wide mouth on the DMI, which means it's just been a very powerful move, very fast, like a 10% move that we've seen in the last 3 or 4 days. And now with that position, and this is why I don't like over trading, because it's more to manage, and sometimes you're going to select some losers, kind of like the LinkedIn one here that's still festering. But Potash at 18, if we sold the 19 calls for next week or for next month, I think that would be something that would be viable to do, just because we have resistance. If we break through that resistance, I think you can definitely go to 22. So you don't want to cut off your upside too much, but when you have a profit built in of 30% or so, I think it was a $3,300 trade that's up 1,200, so about 35%. You can protect that and mitigate this risk by doing this in a diagonal spread. So we can sell the June 24th of this month in 17 days, the 19 calls, which are a 70% probability of expiring out of the money, for about 30 cents on 15. I mean, that's about a $500 credit, which I think is very viable. Maybe a little shorter term is probably what you're thinking. The 17 here, the 19s for next week are 18 cents mid price. So there's definitely a good amount of liquidity with this. This is actually a great one for people to trade with a lower dollar trading account, because you can do a couple of contracts instead of a whole lot. If you have a larger trading account, you can definitely become a market maker because the spreads are still really tight there's still an offer on the 20.5 Junes at a penny, which is better than zero. So I think you can definitely take a stake with any strike that you think is suitable for your risk. Suitable for my risk, I like the 18s because when I got in a couple of days ago, they were a little bit out of the money to where I could kind of wait for this breakout that did occur. And now that we had the breakout, I think selling the 19s kind of right at resistance, right where this moving average is, it's really about 1890, is a smart way to start legging into a diagonal spread. So I think it would be probably more wise to sell the June 17th instead of the 24th. They expire in 10 days. I wouldn't mess with anything this week unless you can actually get about 18 cents for selling the 1850s. That's pretty interesting. That's actually very interesting. So if you think that if potash is going to stay below 18.5 this week, which, this stock is normally a lower beta name, but it had a big breakout, so the volatilities have gone up too. This could be a smart thing. There's still a 65% probability that will stay below that. But I don't want to impose that. I think that's not smart. It wouldn't be conducive for a lot of the traders here. I think it would be smart to give yourself the 10 days, go out to the 19s, because we did have that volume behind this right here. You can see this little volume spike behind that. You could definitely continue forward with the volume there, sort of where we'll see a continuation up to 19. So because I think we can go to 19, I would much rather sell the 19 call to keep a larger upside potential, reduce the gamma risk, and not give up the opportunity of becoming deep in the money on a sold call. So June 17th is the selected expiration. The strike is the 19. 17 cents is the mid price I'm showing right here, which is the bid. So this is a really tight market that there is no mid price because it's only a penny wide. So great product to trade. The one thing I will say, if you wanted to be more bullish and not hedge yourself too much on this gain, then you can definitely modify the quantity, because this position is long 10 or 15. And instead of selling 15, I can sell 10, which would be a viable way to not have that large. Because when I sell these 15, this positive gamma, which has been a driving force to help accelerate this position to where it's rapidly producing more as it goes higher, is going to become a very large negative number. And that negative number will impede on your delta as you start moving that rate of change factor. So the gamma, you just have to think, is like your velocity indicator or your velocity movement. So like on this SLV velocity, a minus 850 on a 921, that means this is telling me, so that you can have literally 100 positions and kind of go down the list and see where your exposure is. That is telling me that we have the ability to go from long 900 to short 900 on a $2 up move on the underlying. So if you have a large position at place and it's something that you had to set on top of, you would ideally take that information and put an alert somewhere around, say if we're trading at 15.60, somewhere around $17, and that would mitigate you to do something. So if you had to, cover a short and make sure that you're not losing money on too large of a move. Brian, sorry that you had to step out. ERX, I want to get to that here shortly. I was just finishing up the discussion on potash, which we had a pretty decent gain here the last 2 weeks from when it was put on the 26th. I'm going to go ahead and sell the 19 calls for the June 17th expiration for next week. And it's such a tight market that I don't have to really try to get anything off that. It's a fair market. The main thing is, do you want to sell 10 or 15? I don't mind selling 15 and bring in a $250 credit, which I'll continue moving out, and it failed right away. So it's a very liquid product. I definitely think this is a great one to paper trade too, if you're just getting started, because it's liquid and there's penny-wide markets and it's not too expensive of a stock. A lot of ETFs are in this, upper teen 20 range. And now this position, which went down here, there we have it. So now you can see that 400, I just cut my deltas in half almost. And now, that rate of change factor, that's the natural trade-off with having now the ability to make $21 a day on this. And I'll continue this whole process out for, indefinitely. And this is something that's proven to work and something that we can now talk on Apple. But for Apple, all I did was I bought back the 98 calls that were in the same expiration for June 17th for like $100 profit, just because I saw that some more upside, which is helping today. So, right now I don't have 10 calls sold against the 12 longs. I have 5 because I want to change this. I want to change let me get my little magnifying glass. I want to change my delta right here. My delta was it was at risk because I had too large of a gamma. So if I was thinking that Potash was going to trend up to 21 or 22 in the next couple of weeks, or really within the next 10 days, since that's my expiration, then I would definitely want to modify that so that I can partake in that process, which had a pretty strong day. So, I mean, we could definitely stay in this channel too. Like, I wouldn't take this day as a significant, reason to completely modify the whole trade. I mean, it's definitely an eye-opening day that makes you think about your position and what you have to do, but you don't want to panic and do something too reactive again. I think it's important to stay true to your option Greeks. I mean, so we lost our positive delta. Now we're basically flat to stock, still making $30 a day on this. And, I think with Tesla, you could certainly wait it out a little bit. Maybe you put an alert in at 237. If it goes past 237, that's a $6 move higher. Call it 238. $6 on this times. I mean, you're not really going to lose a lot of money if it goes too much higher. You're going to still have your positive theta. These deltas and gamma is not that worrisome. I mean, if it goes and they start changing on us now, if we go to 240, then that's a different thing. But you got to remember that these options were sold for about $3. Now they're about $8. So, I mean, I think it would be, I could. The other thing too is when I start to break these trades up, which if I was managing a portfolio for someone and I wasn't teaching this and publishing these trades, it gets very detailed and confusing, and sometimes it's counteractive or counterintuitive to do that. When I'm like, for example, like one thing that you can do right now to be really proactive when you see this happen, which I'm going to do, and then I'll explain it, is take half of these sold calls, which is the main reason why I have this positive thing and why this whole position's on, is because it makes that money through past time. And now today, which we got a decent move, we had already bought back those 235 calls. So, we were probably down a couple $100 now, which was down a lot more. It was probably down 30% at one point. Now we're maybe down 5 or 10. And to continue this process and let this continue working, we need to go ahead and create a rolling order on part of it. And another thing that I want to emphasize, which I think about a lot, I always think about analogies with the stock market and life, and I don't want to go off on a tangent, but I will say that when you're trading and you put on a position that's originally bullish, and then you get a down day, or you're like, oh, I want to go bearish, or I want to take off my delta, and I want to change my directional risk. And then you're partially right. And then when you say you want to change it back, so what I'm saying is when you're bullish and then you kind of become neutral to bearish, and then when you want to switch back to bullish, a lot of times it's going to cost you extra money, and it's going to be kind of counterintuitive to your trading. So you want to stick to your beliefs. If you keep changing your mind on a trade, it can definitely create a lot of confusion. And I think if you ever get confused, which we all do, including myself, then you just have to refer to your option Greeks so that you can see where your risk is and understand how you got to that position. Because what I'm about to do right now could get confusing, because I'm going to break up this sold 230 call. I'm going to sell 3 of them into a rolling order up to 235. And the reason why I'm going to do that is because we have this Fibonacci line, which is really accurate. It's traded very accurate and close to this throughout the first half of the year. And that 23.6% retracement right around 237, we could definitely hit our head there and trade sideways for a couple of days. So I would like to sell the 235, roll up this position. You could roll up the whole position, or if you wanted to do part of it, which is, I think, the smart thing to do to teach this also, is taking these, let me close some of these up, taking these sold 230 calls that expire in 17 days. So, we definitely have to be, you have to think about the expirations not getting too far out. So keep it the 24th and and you might pay, this is going to cost me. Remember I say, if you change from bullish to bearish back to bullish, a lot of times it's going to cost you something. So this is the process to do that. And what I'm doing now is I'm going to buy back 3 of these.
and I'm going to roll up to the 235. And now it's going to cost me $750. So what I'm saying is when you really start changing back and forth, which we're all guilty of doing a lot of times when you really learn this business, because the market's changed on us constantly, then this is the effect of that is a lot of times having to put more capital in, which this debit of 255 is going to cause almost another $1,000. And so let me think about this for a second. See, I'm not that worried about this risk. I mean, this can definitely change. And the higher this number goes, like the more negative it gets, then the theta is going to start decreasing because the integrity of this position is going to be out of whack. You don't want to have sold calls become deep in the money. That's how you get, things to kind of turn upside down on you. So when you get, like today, the stock was at 220 yesterday. Now it's at 232, a relatively large move for one day. There's still 17 days on these sold calls, and they're already $2.67 in the money. So the way I look at that is $8.42. Subtract $3 from that, there's still $5 of time value. $5 times 5 contracts, there's still $2,500 of premium in these sold options. So you can't forget about that. And that's why there's still a lot of value here. But in order to be proactive and roll up to the 235, it's an unemotional decision because it's just a matter of modifying your delta. And when I did this to begin with, I think we brought in a credit by rolling this down. So I think now to roll back up, it's the inverse of that act of going from credit back to debit. So this is why when we look at this position over here, this 245 debit for the same expiration, and let's see what we can do for the 17th. Maybe you do that. So that's a little more. That's about $1,200, but at least you're selling something that expires faster. And let me look at the short-term chart real fast. I mean, a lot of times when you get these really big moves too, you see some sideways consolidation. So I don't think next week is too far out, but the stock can definitely go back to 240 or 250. So this is a pretty interesting point that we're in, and this is good for me to do as an educator because it's a challenging thing to decide a direction when you see a breakout because you can get faked out, and then you can continue that breakout to where you can really make a great profit if you make a smart and really important decision like right now. So right now is we're threatened, we're in the money on this. So what I could do is completely buy back these 230 calls. So we just got filled on the ERX for 25 cents. So we still have 5 of those sold. And the reason why I have 5 of these sold is because I want to keep a positive theta. These are losing $11 a day. And if I sell half of these, look how I reduce my delta. So even if this stock really runs higher, which maybe there's a 70% chance or an 80% chance that it's not going to be above 35 in the next 10 days, I think it's a smart practice to keep that mentality and keep that relationship of having a positive theta, even if you have a little bit of a negative gamma. That's a lot better than having a really large negative gamma, which is what gets you into trouble sometimes. Kind of like this relationship, having a gamma that's the same as your delta. That's an example of a complete modification and change in a trade when you get a really big move, and those are at the same kind of metric. So last thing I want to talk about here before we talk about some new trades is for Tesla. If you think the stock's going to continue to go higher, like to 240, there's nothing from stopping me to turn this into a July 230, 240 vertical call spread. So the other thing that you can do is take this, create a rolling order, and sell the same option expiration 240 call and only pay $1.18. So this is probably the smartest thing to do because I think this was originally a vertical when I put it on, now that memory serves me back. And I bought back I think it might have been 230, 235. Doesn't really matter, but I think the trade started as a vertical and I was wrong on the direction and I turned it into a counter. And now to turn it back into a similar or maybe a wider vertical, I think is a smart play because it's going to give me that delta that I want to partake in this continued upside move that we could very likely see into the rest of the weekend and maybe into next week too. And I think this volume behind this is something that you can't ignore. And the stair step kind of mentality. I mean, we got a low in here, kind of a consolidation. Set the low down here at 205. We're looking at a 180-day 4-hour chart. The 20-day 1 hour is going to be, I mean, pretty substantial breakout. I think you could test 225 again, but it looks much poised to continue higher. So turning this into a vertical makes a lot of sense, and it's a lot cheaper than doing the other trade. So 587 is the debit to turn this back into a vertical, and that's working right now. Mark has changed to 117.5. So what I'll do is I'll just bump that up to 118, which is right here. You can see the mark. It's important that you kind of see this process so I don't lose you, because I know I talk fast and I kind of get a little excited, but the most important thing is to be able to replicate this for yourself so that you can make these same decisions, because this is how the same professional money managers and traders. So it's at 115. So there's definitely fluctuation. Since I'm on camera, I can always have that excuse that I can come a couple pennies off mid price to get this filled so you can see it. But if you're staying true to your trading workflow, always try to get filled at mid price, because that means you're not getting taken advantage of, which is something we always preach in here. So 118, I'm going to come off a little bit just to get that filled and show this modification in the option Greeks. So 118, 117.5. I mean, you don't want to come too much off mid price. Maybe 120 is the most I would do. I mean, every couple pennies that you move could be, several dollars or hundreds of dollars. So 120 was what I sacrificed. I sacrificed a little more than I should have, but the important thing is seeing how this trade looks now. So I had a flat delta, and now what I just did was I'm long like 50 deltas. And if I move this to the right group here, you can see it right here, the Tesla position. So now, I'm not really losing hardly anything. It's very minimal. And I have this nice rich delta position that if we can see another $10 upside move, then it can definitely make a profit and continue to do well. But the whole purpose of this trade is to trade up to 240, which is the sold expiration for the July 15th. And this trade is something that you can put a sell order in, but because I chopped it up a little bit and got a little messy with adjusting it twice and going from a vertical to a counter back to a vertical, which is what I think the flow was on this, then it's something that I want to definitely do in the detailed update before spending too much time explaining that. So this could be a great trade where you buy the 13. I mean, this breakout today, all of these 4 moving averages being together and kind of all intersecting is a really powerful thing to see. And it's a very rare thing to see, especially when you have a base at 7, a base at 10, a base at 12, consolidation in 13, a breakout with volume. I mean, it's not textbook, but it's pretty close to it with a lot of bullish factors to buy and get a position established. So the only thing that's kind of definitely holding me up is these lows over here. Definitely gap through them there, which is confirming that this was legitimate support, which turned into resistance here. So 15 is a level that maybe 16 you can push it to, but 15 looks like a level where it could hit its head, which is kind of right at. So if I was going to put a trade on this one, it would be, I like it. I like buying maybe a 13 call and selling a 16, maybe doing a vertical call spread, something that's simple and easy to manage and proven to work. Give yourself maybe the October options could be good. I don't think we have to go out too far, and this volatility is interesting. But when you're buying and selling, and also look at the spreads is important too. So the Octobers are perfectly fine. I mean, they're above 90 days, so I don't have a problem buying a debit spread at 136 days. I think that's a very normal part of my trading strategy and what we're doing inside the club here. So I like the penny wide markets, because these are not 5-cent increments like the 335, 355. The 268 definitely has my interest with the volume today. Open interest is probably very strong here, but we don't need to look at that. buying the 13 call and selling the 16 or 17. So if you ever get confused, you can use this probability out of the money tool to help kind of keep you structured. Like 75% probability that it's going to be below, this is probably out of the money, below this the strike price is not very good if you're buying that. We're buying an option that has a 44% chance of being out of the money. So we have a 60 or a 55% chance that it's going to stay above 13. And if we sell the 75, which is the 17 call, I think doing a $4 wide spread for about $2 makes a lot of sense. And it's going to be a 2 for 2 or 1 for 1, risking $2 to make $2 if I'm correct. So the mid price, it's actually a little better. So the three things I like about this trade is it's very simple. It's not too complex. It gives us enough time, and it's in a horizon where it could start to make a profit relatively quick on it if it moves continue higher into the 16 range where resistance is, or 15, 16 range. We can take it off next week or in a couple of weeks for maybe a 20 or 30% profit if deemed necessary. We're conservative enough with the October expiration to not see too much fluctuation on these because there's a lot of extrinsic time value still. And the $4 wide spread is an even strike width differential where it's easy to calculate. Max profit of $400 per contract. So if we did 10 of these, that's an $1,830 trade that can produce a max profit of $4,000 minus our cost, which is $2,160. So risking $1,830 to make $2,170 now. If I analyze this, just to show you the risk profile, you see that the risk down here flattens off at right under 2,000. That's the 1,830 risk. And then the profit right here is the 2,170. So you can see as you go out here, that's where you level off. So this is a good strategy. That's not going to be one that you would want to use ideally. I mean, it's still going to be a bullish one, but if you think the stock's going to 20 or 25, you might want to have a positive gamma. But this is one that is still relatively conservative, and we definitely are at a high right now. We had a breakout, so we're kind of buying at an optimal time for the sellers because we're hitting a little bit of resistance. But I think even if we pull back to 13 or 14, it's something where you're going to be okay because you have 5 months for this to manifest on this trade. And sometimes you're never, and a lot of times you're not going to get the best fill. It's just like on that recent Potash trade. You know, it took a week or two since this execution, which is, you know, these calls are up $50. Say that's showing you how that's working. But it was 5 days, the end of April plus 6. It was 11 days. It was right under 2 weeks before this manifested and gave me the luxury to even sell calls. So sometimes when you sell calls out of the gate, it's not the most optimal thing. At least I have a built-in profit now to where I'm hedging this so that if it does continue to go higher, I'm still going to make more money from the sold calls, and I'm not going to really have the position ever go upside down because I already have this really large built-in profit on a relative basis. So 5 minutes to go. I like the Marathon Oil trade. I definitely appreciate the idea, Brent. Great job, man. Doing great. Got some awesome ideas. And it's great to see the growth and the prosperity involved in the community. It's a beautiful thing. So with this trade, you know, I have that new spreadsheet that I'm actually really excited about. It's something that I spent a lot of time on to get here, and I'm going to pull that up here shortly just to get this with you. But because we have 5 minutes left, I'll do that after the market closes. This should fill right away. I want to spend the last minute here talking about the open interest and why this is a good security. So the open interest is over 2,000 contracts, very liquid, and these are penny-wide markets, so I think it's a very efficient one to trade. The strike prices were selected in accordance with the technicals, very kind of prominent time in this security because of these intersections that we're seeing. If you look at a 10-year weekly, I mean, that's a nice, beautiful little stair-step pattern. Bullish, bullish. It definitely looks like it can go to 16 or 18 in a conservative way. It could go to 20 or 25 in a year from now. So, maybe you talk about another idea. There's definitely some major resistance at 15.5 because of the lows back in 2009. Now I'm seeing. So I think we have the ability to break through that, though. Volume is a little bit low, so there's not everything perfect. And this is looking at a weekly chart again. A 5-year daily, the volume is still pretty good. But longer term, we definitely might be trading sideways. That's why, buying the leaps is great. And if you think that's going to happen, then it could. But if we trade in a sideways channel and we're already buying the 13 call that's in the money, our break even, you should be able to calculate, in your head right now, looking at this 13, 17, $4 wide, long vertical call spread, $1.83. The break even is going to be at $14.83. So that's only 20 cents away from where we're trading. So the break even, the stock can go sideways, it can go up 50 cents, go up $1, stay sideways, and we're going to be okay. So I think it's a safe, smart trade, not too much maintenance, and we'll go ahead and get that filled for 1830. 1790, it just fluctuated. See if that was a joke or a tease. Yeah, that was a tease. So 183 is mid price. That's 1855 after commission filled. Efficient, gotta love efficient markets. So we'll go ahead and put that in the option income strategy, since that one needs some love. That's a portfolio that is going to be more conservative, some directional, some income producing trades. But this one right here, I feel good about it. I think it's well laid out. It has no theta because of the strike price selection. And the one thing I'll say with this is, as the stock continues to move higher, or if it continues to move higher, which I think it has the characteristics to do so, then this theta will start to slowly become positive as it goes past that break-even point at 14.83 roughly. So call it when we get to 15, this position will start to have a positive theta, and anything but above 15 to 17 is great. And if we go above 17, that's where we hit our max profit. So if we can get to 17, then you can definitely take it off early. I think with this trade, the last thing I'll say before the market closes is risking right under $2,000 at 1810 is the net liquidation, down $20. I would like to get, at least on a trade like this, for that risk and the selection, at least a 50% return. So somewhere between $800 and $1,000 is the ideal goal on when I do the trade write up in the update. So the last thing you can understand is that if we get a $3 move, because it's long 325 deltas, a $3 move, it's only going to detract that down 15. So you're still going to make around about $900 on a $3 move. So what I would do to close this out is, if we get, which of course, if we get a move to 17, we're going to see it in our watch list, but you can always put an alert out there. And the thing I like about this strategy is you can sell half at maybe a certain price and then have another half on if you want to take off some quick profits if they become available. But that's today. So let's see what the market closed out at. And if there's any last minute questions or anything that I can help you with, definitely feel free to chime in. So flat day. The NASDAQ was the one that kind of fell off the cliff today, down 11 points. Dow closed up 18. The S&P closed up 3, flat. The gold is flat. Russell 2000 was the winner of the day, up 0.25%, 3.5 points. And oil had a pretty solid day, up 1.5%. So for the most part, I think everything's pretty structured. Kind of a flat day overall for both the markets and the trades in here. Definitely could have done better on TripAdvisor execution, and I might modify that some more. But right now, that was the best I could do to mitigate the pain without taking a loss. And it's a good example of getting faked out and how there's no perfect crystal ball and technical analysis. Potash was a nice trade that was put on recently that we got the ability to sell calls on today. And Target, and we have the Wells Fargo trade. Those I'll be talking about in Leaps classes. And then Nike is coming up on earnings, which is up top here, which I'll save for another day, which is more of an aggressive trade. But Great session. Glad to have you all with me as always. And if there's anything else that you need, feel free to chime in. I do have a lot of events coming up for the Leaps classes, and I have Thursday. We're going to do a money management and capital allocation class. I've been getting a lot of questions, and I was planning to do this last month, and then I wanted to give myself some more time and had some other things in the way that figured, this would be the perfect time right when summer's kicking off to really think about your risk, your capital allocation, and having a workflow of how much you average put on a trade, and talking about, I also have a spreadsheet for you that you can use to help automate your position sizing. So, and you can scale it, and you can kind of separate your accounts, which I think is very smart. Maybe you have, your Leaps in one account, you probably have your retirement account. You're going to have separate money that's spread around to where you might want to kind of utilize this capital allocation and kind of formula to keep you systemized and structured, so that if you do have a losing trade, and you will have losing trades, we all have losing trades, and you follow this formula, this system, it's not going to crush your account. There's absolutely no reason to see a 10% reduction, or even a 7 or 5% reduction in your portfolio on a monthly basis when you are putting in the proper triggers and the proper money management. And if you're over allocated, or if you have too much exposure or poor risk reward on a trade, those are what can get you in trouble when you're doing these types of investments. And that's what I want to address. So that's coming up on Thursday morning. I'll have another email out with these recent updates. The spreadsheet is my focus, to get that continually updated and then keep everything rolling. So if there's anything else that you need, feel free to shoot me an email or message. And I appreciate you all, and I'll talk again soon. Take care, happy trading, and thanks so much.